Hey guys, so now that many countries are starting to transition out of the pandemic and the lockdown period, economies are starting to reopen and restrictions are loosening across the globe. Now, over the pandemic period, many individuals have become accidental savers, finding themselves with more savings than they have ever had before due to not having anything to spend their money on. So there is therefore a lot of pent-up demand for goods and services across the wider economy, but not necessarily the supply to match this demand. On top of this, many governments were forced to print new money in order to soften the economic blow of the pandemic, increasing the overall money in circulation. Specifically, the US government released several stimulus packages for a large portion of the population, essentially giving people free money so they could get by with rent and food and stuff like that to soften the blow of the pandemic. So because of these reasons, we are starting to see the early signs of inflation taking place, with some people believing that this is just the start of a prolonged period of high inflation. Now, this could also mean that interest rates are raised in order to increase the cost of borrowing money, while increasing the incentive to save money to try and combat inflation. If we enter an environment where inflation is high and interest rates are increasing, then this is likely to be bad for certain stocks, specifically those that are still in growing phases of the company or are not well established as of right now, as these have a low or negative cash flow and rely on borrowing money to fund their operations. So with a lot of people not sure where to put their money in times of high inflation, if we do start to see inflation ramp up in the next year or so, I thought I'd make this video to take a look at several asset classes that are potentially good options to invest in if inflation is to keep on increasing, and they are a wide variety of assets ranging from stocks to alternative assets. So hopefully there's something here for everyone to take a closer look at and maybe consider putting their money in it to combat inflation and to actually beat inflation. If you do enjoy the video or find it useful, I'd really appreciate it if you left a like, as that does help out the channel a lot. Also be sure to subscribe if you'd like to see more videos similar to this in the future. But apart from that guys, let's get right into it. So first off here we've got real estate. Now, in a high inflation environment with the cost of materials increasing, the cost of building a new house also increases with this, driving property prices up for existing real estate as well. New house builders will need to pay more money for raw materials like lumber, bricks, stone and other materials, which means that these extra costs get passed on to the eventual buyer of the property. And with real estate building costs going up, all existing real estate that is already built will benefit from this as well, with an increased market value. Real estate also has an inelastic supply, meaning that the supply of new houses does not increase in line with the increase in demand. It is very time consuming to build a brand new property, especially if it is a large development like a block of flats for example, as these can take many years to build. So from start to finish it often takes many years to get planning permission, to acquire the land and to finish building the property, and this means that the construction companies cannot instantaneously react and respond to a rising demand for real estate, meaning that a supply increase cannot balance out the demand increase straight away, and it does take quite a bit of time for this to happen. Leveraging debt is also a great way to benefit from real estate during a period of high inflation. You can take out a loan today to buy a house when cash is at its most valuable and pay back this loan over time as the cash becomes devalued over time due to inflation. So as inflation continues to tick upwards over time, the purchasing power of that loan becomes weaker and weaker, meaning that inflation is essentially eating away at your debt that you have. For example, if you borrow $100,000 to buy a house today, then that $100,000 in cash is worth a lot more today than it will be in the future. This is because the purchasing power that it has today compared to in 10 years time, for example, is a lot stronger, and the inflation over time will essentially eat away at the debt that you do have from this loan. And then finally, those who rent out their real estate can benefit from increasing the rent that they charge in line with inflation. For example, many rental contracts give the landlord the ability to increase rent every year in line with inflation. So if inflation for a given year is at 5% and you're charging your tenant $1,000 a month in rent, then you can increase the rent you charge to $1,050 per month to account for this increase in inflation. And in this case, not only will you benefit from the appreciating price of the property that you own, but you will also be receiving an inflation-adjusted monthly rental income from the tenant as well. So you'll be benefiting in two different ways. So next up we have commodities. Now, tangible assets like commodities are what many investors turn to when their native currency is becoming devalued through inflation. Commodities are real physical assets that have value because they are used for manufacturing or other parts of the economy. Some examples of commodities include gold, oil, lumber, cotton, and copper, just to name a few, and all of these commodities play an important part in our economy and are used to produce and manufacture a number of important and highly desirable items across a wide range of sectors of the economy. Commodity prices tend to rise in line with inflation, as if there is a high demand for goods and services in the economy, then this will often lead to a higher demand for these commodities that are used to provide these goods and services for people. So gold is often an inflation hedge that many investors do turn to and has historically performed very well during periods of high inflation. So next up we have maybe a bit of a controversial one, and that is Bitcoin. So Bitcoin is a relatively new asset class and has therefore not stood the test of time, but logically, Bitcoin should perform well in a high inflation environment. Bitcoin is a deflationary asset that has a fixed limited supply of 21 million Bitcoin. Not all 21 million Bitcoin have been mined just yet. However, the amount of new Bitcoin being generated every day halves every 4 years. With a supply that is constantly decreasing by 50% every 4 years and a hard supply cap of 21 million coins, which cannot be changed, altered, or manipulated, many people believe that Bitcoin is a digital version of gold that does gold's job in a better way. Now, Bitcoin is extremely volatile, especially over a short period of time. However, due to the deflationary attributes that it does have, it is considered the hardest money on earth by some people, and the trend line since its inception in 2009 has been upwards. When a currency is rapidly losing its value over time, it makes sense for investors to flock to an alternative digital currency that has a 10+ year history of continuously going up in price, that also has a supply cap on how many coins there can ever be in existence. I believe it is quite possible for us to see a big rally in Bitcoin if inflation continues to increase in the next few months and few years, as investors do look for an asset that cannot be manipulated and has a limited supply cap of the amount of coins that there are. So the fourth and final investment that I'm going to be covering is stocks that have a high cash flow. So growth stocks for companies that are in their infancy tend to perform quite badly through high inflation periods. However, there are some types of stocks that can hold their own and perform well. Some key attributes of these high-performing stocks does include stocks that have a high cash flow rather than needing to borrow cash, stocks that have dominance in an entire industry or sector and have a large moat with them as well, and then stocks that have the ability to hike their prices in line with inflation, passing on the extra costs that they do take on to the consumer. Having a high cash flow means that the company are completely self-sufficient and don't need to rely on borrowing money to finance their operations. This means they don't take on higher cost of borrowing money due to the higher interest rates that may occur during high inflation times. And many mature and well-established companies do tick this box, whereas this is not so much the case in companies that have only been around for a few years and are still growing at a fast rate. Now, having dominance in a sector while also having a significant moat means that a company already has a dominant market share and is not so much at risk of other companies starting up and stealing their customers. Now, this often allows them to flexibly increase their prices in line with inflation so that they are not suffering from inflation as it happens. A couple of quick examples of good inflation-proof stocks are Procter & Gamble and Google, just to name a couple. So P&G have a mature and well-established business generating a good free cash flow level without the need to take on debt. Many of their brands are dominant in their sector and sell essential items relied on by many consumers in their day-to-day life. This allows them to increase their prices, passing on the extra inflation cost to the consumer without the risk of losing their customer base. Also, Google are a very asset-light business that don't need a lot of capital to operate and generate impressive free cash flow. Google have dominance in the online advertising sector with their platforms like Google Search and YouTube, and businesses will continue to advertise online and will therefore still be willing to pay for Google and YouTube adverts, even if Google do increase their advert costs to account for inflation. So that's all for today's video, guys. I hope this video did give you some insights and some ideas on potential inflation hedges and investments to counter high inflation. Please do remember though that these investment ideas are purely based on my own research and my own opinions, and I am not a financial advisor, and this video is not financial advice. Please be sure to do your own research before you think about investing in anything. But with that being said, guys, please leave a like if you did enjoy the video, as that does help out the channel a lot. Also be sure to subscribe if you'd like to see more videos like this in the future. Drop me a comment, let me know what your favourite investment idea is from this video to counter inflation. And apart from that, guys, thanks a lot for watching.